In today's episode, I'll talk about two interesting stories. In the first one, I'll talk about why the Indian government recently banned pharmaceutical sales representatives from entering government hospitals and what all of that really means for how medicines get prescribed in our country. And in the second story of the day, I'll talk about how India's four biggest tire companies are making wildly different bets on the future while they are dealing with costs that they cannot control. Welcome to the Daily Review Show by Zerodha, where our aim is to cut through the noise and simplify the biggest news and stories in the financial markets in a way that is easy for all of us to understand, yet one level deeper as compared to your traditional news channels. I'm your host Anurag Bansal, and today is Tuesday, the 17th of June. See, for many decades, if you walked through the corridors of any major Indian hospital, you would spot certain kind of people. Well-dressed professionals carrying briefcases waiting outside doctors' chambers, or for that matter, chatting with medical staff over a cup of tea or coffee. Now, these are pharmaceutical sales representatives, or MRs as they are known in the industry. Their presence in hospitals has become so routine and so normal nowadays that people like you and I would barely even notice them. They are as much a part of hospitals' ecosystems as nurses, attenders, or even the tea stall that's outside the hospital. But just a few weeks ago, the Indian government decided that this needs to change. The Directorate General of Health Services issued a stark order to all central government hospitals which said no more pharmaceutical sales representatives on the premises. No more wandering on the corridors, no more dropping by clinics, and no more casual chats with doctors between patient appointments. And now, if drug companies want to share any information about their products to doctors, they will have to do it over email. Now, I know this might sound like a very small administrative decision at first to all of us, but it has actually sparked a very big clash between the health ministry and the pharmaceutical industry. The Indian Pharmaceutical Alliance, which represents our country's biggest drug makers, has called this a blanket ban which could do more harm than good, and they are urging the government to reconsider it. Now, this controversy reveals some deeper questions about how medicines are marketed, prescribed, and also accessed in our country, India. But to understand why all of this matters in the first place, let's very quickly understand what these medical representatives actually do in the first place. See, their job, in very simple words, is to be the human connection between drug companies and the doctors. See, when a company develops a new medicine, it is these MRs who ensure that doctors know about it. They basically show up with brochures, scientific studies, and sometimes even free samples for the doctors. For example, if a company just launched a new diabetes medication, their MRs will visit endocrinologists to explain why this particular drug might be worth prescribing. Now, of course, in theory, everybody benefits when doctors stay updated on the latest treatments, of course, right? But here is where things get slightly complicated. The thing is, these representative doctor interactions are not just regular educational seminars. They are also marketing opportunities, and a lot of times it is very hard to tell where education ends and salespersonship begins. In many cases, a skilled MR does not just share scientific data, they actually end up building relationships with doctors, they remember their birthdays and even know their personal preferences. Now, in the best cases, this means providing genuine medical updates to help the patient care process. But in less diligent cases, this means nudging doctors with conference sponsorships, fancy dinners, or outright gifts to prescribe one drug over a competitor's drug. And the line between education and promotion is not just thin, it is usually invisible in many cases. And this creates an obvious ethical problem. See, over the years, many MRs and their companies have crossed whatever line might exist. Doctors have been lured into foreign trips, expensive gifts, and even cash incentives disguised as speaking fees. And if you think about it, if a patient ends up paying for a costly branded medicine just because their doctor was carried away by, let's say, a week in Switzerland, courtesy of a pharma company, that's not just unethical, it is also potentially harmful. Sure, of course, the medicine might work okay, but the question is, was it chosen for the right reasons? That is the big question. See, health authorities and watchdogs have for a very long time feared what could happen without proper regulation here. Because without clear rules, hospital corridors could sort of turn into bazaars of influence with MRs competing to see who could offer the most attractive incentives. Doctors' offices could also become sort of auction houses where prescriptions go to the highest bidder. And the very trust that support doctor-patient relationships could sort of be corrupted by these very commercial interests. Also, mind you, this is not just an Indian concern. Around the world, countries have struggled quite a bit with how to manage the relationship between drug companies and doctors. The United States has something that they call Pharma Code, which sets boundaries on what companies can and cannot do. Europe also has something that's called the EFPIA Code of Practice, which is essentially rule books which say share scientific knowledge about your products, but do not try to influence doctors with gifts, travels, or other perks. Now, India also introduced our own version of this in 2015, and it's called the Uniform Code of Pharmaceutical Marketing Practices. And this code was meant to discourage aggressive marketing tactics and bring in more transparency into the process. But I'll tell you the most absurd part of it. For many years, this code was entirely voluntary. Companies could follow it if they felt like it, or they could completely ignore it if they did not feel like it. There were no penalties, no enforcement mechanism, and no consequences for violations whatsoever. But that changed in 2024 when the government decided to give this code a little more teeth. They upgraded it to something called quasi-statutory status. Now, quasi-statutory, for your reference, means that it's not quite a law, but it's more like just a suggestion. There is still no government regulator with the power to hand out fines or prosecute violators. If a pharma company sneaks a gift to a doctor, for example, nobody is going to go to jail, but instead, enforcement relies mainly on industry bodies policing their own members. Pharma associations can suspend companies which break rules, but that's almost like asking students to grade their own exams, to be very honest with you. Now, the updated code specifically bans obvious violations like luxury gifts, sponsored foreign vacations, or personal perks for doctors, and it has created oversight committees to monitor compliance. But without real legal teeth, it remains more like a stern warning than an actual deterrent. But that said, this renewed focus on ethical marketing, however limited it may be, has created the context for the Health Ministry's latest move. In late May 2025, the DGHS looked at the situation in government hospitals and they decided that having drug representatives roaming around was a part of this problem. Doctors were spending time with salespeople instead of patients, and there was always the risk of undue influence on prescriptions. Waiting rooms were also getting crowded with both patients and pharma representatives. So the government then decided to implement a simple solution, which is ban them entirely. Now, the pharmaceutical industry immediately and obviously pushed back. In a letter to the Health Ministry, the IPA argued that this blanket ban goes too far. Yes, of course, the agreed unethical behavior needs to be stopped, but MR served what they called critical educational role in healthcare, and instead of banning them completely, they suggested why not create structured interactions. They basically suggested setting specific days or hours when these meetings could happen with doctors, and that too in designated areas away from patient zones. The industry also warned about some consequences that the government may not have fully considered. Thousands of MRs could lose their jobs, and the flow of information about new treatments might completely be disrupted. But here is where the story gets slightly more complicated and where the big loopholes and weak spots in this entire approach become very clear. See, the thing is, this is not the first time the government has tried this. A nearly identical order went out in 2023 telling central hospitals to curtail MR visits and have drug information sent digitally instead. And the fact that we are seeing the exact same directive in 2025 tells you something very important. The earlier ban was either not enforced properly or was quietly abandoned over time. So if a rule needs to be announced twice in 2 years, it's not really a rule, it's actually a wish in many ways. And this pattern of announcing rules without following through is not unique to MR bans also. There is one more rule that has been around for many years, requiring government doctors to prescribe medicines by their generic name rather than brand names. And to understand why this very specific thing matters, quickly think about how you yourself buy your medicines. See, for example, if your doctor writes Crocin on your prescription, you will obviously end up buying that specific brand. But if they actually write paracetamol 500 mg, you can end up buying any brand of paracetamol, which might be much cheaper in some cases. And this generic prescription rule was meant to help patients save money and reduce the influence of brand marketing. But if you walk into any government hospital, you will find that this rule is routinely ignored nowadays. Doctors still write brand names and there are rarely any consequences. As per rule, a government doctor who is caught pushing specific brands could technically face action, but in reality, it never really happens. So the rule definitely exists on paper, but not really in practice. So back to the MR ban, even if it is enforced this time, there are obvious workarounds. The 2025 directive itself acknowledges that MRs can still share information digitally through emails, video calls, WhatsApp groups, or even online newsletters. In fact, according to a recent study, digital promotion has already become more prominent, especially ever since the pandemic. So the influence does not really disappear, it only changes channels. Instead of face-to-face meetings in hospital corridors or hospital rooms, you might now see more Zoom presentations or targeted email campaigns. But anyway, perhaps the most revealing insight here comes from extensive conversations with industry insiders doctors who explained something very critical. In government hospitals, the entire debate about MR influence might be missing the entire point, because the system for getting medicines to patient works completely different than most of us realize. See, government hospitals do not really operate like private hospitals or even your neighborhood pharmacy for that matter. They use something that's called a tender system. I'll tell you how it works. See, first the hospital announces that it needs, let's say, 1 million tablets of paracetamol for that particular year. Different companies then bid and they offer their best price. The hospital eventually picks the winner based on price and also quality standards. And that company's paracetamol then gets stocked up in the hospital's pharmacy and is given for free or at a very low cost to patients. Now, this system has huge implications that most people like you and I do not even realize. See, in a government hospital, it does not even matter which brand of paracetamol the doctor prefers or prescribes. The pharmacy has only one brand which won the tender. So if you are a patient that's getting free medicine from the hospital, you will obviously end up getting whatever brand the hospital has stocked, right? And the thing is that most patients at government hospitals come from relatively lower income backgrounds and they have to depend on these free medicines. They are not going to go outside and buy a different brand with their own money in a lot of cases. A senior pharma executive who was speaking about the reality of this business put it very bluntly, and he said, most businesses in government hospitals come from tenders, not really brand promotion. Now think about what this means for a medical representative. If a company's brand is not the one that the hospital stocks, no amount of relationship building with doctors will anyway help. The real prize is not getting doctors to prescribe your brand, it is actually winning the tender so that your brand is the only one available in the hospital's pharmacy. Getting on the hospital's official list of stocked medicines is what actually drives sales in the public sector. Now many pharma companies have figured this out. They don't even bother sending representatives to government hospitals where they have not won supply contracts because it is simply not even worth the effort. Because why spend money on MRs when the real action is in the tender department on the other hand? So now if you think about this in the context of the ban, this suddenly puts the entire ban in a very different situation. The government is trying to solve a persuasion problem in an environment where persuasion does not even matter in many cases. The real competition is not in hospital corridors, but actually in tender applications. And wherever public hospitals are concerned, having medicines available in the hospital's pharmacy actually matters much more than having a doctor recommend it. So what we are left with is a situation where both sides claim to have the patient's best interests at heart, but they are essentially talking past each other. On one side, the government is citing ethics and the need to unclog hospital pathways, and on the other side, pharmaceutical industries are talking about keeping doctors informed for better patient care. Of course, none of them are wrong, but they are not addressing the deeper structural issues. The core questions still remain unanswered. How do we ensure doctors get unbiased information about new treatments without commercial pressure? How do we enforce ethical marketing in an industry that's largely self-policing, even when upgraded rules lack real teeth? How do we protect patients, especially in public hospitals, from being pushed towards costlier options for the wrong reason? And perhaps, and most importantly, how do we create a system where violations actually have consequences? Now, until we address these fundamental issues, we are likely to see the same drama play out again and again. Another year, another circular, another ban, and another round of protests. This time around, the playing field might shift slightly with more digital marketing and fewer physical visits, but the underlying tensions between commerce and healthcare will still remain. Now, what this controversy really reveals is how difficult it is to regulate an industry where profit motives and patient welfares are supposed to coexist, but they usually pull in exactly opposite directions. That brings me to the end of the first story of the day. Let's now move on and talk about the second story. There is something very uniquely difficult about being in the tire business. Most of us do not think twice about tires. They are just black rubber rings wrapped around our wheels. But the thing is, behind that simple product is a business that is filled with risk, unpredictability, and enormous long-term bets. Imagine running a company where 80 to 85% of your costs come from materials whose prices you just cannot control. It's almost like trying to run a restaurant where the prices of ingredients changes dramatically every single week, but you still need to keep your menu prices stable. That is exactly what India's tire companies face every single day. Their two biggest expenses, which is natural rubber and crude oil derivatives, are globally traded commodities that can swing by 30% or even more in just a few months. In late 2024, for example, rubber prices suddenly jumped by 33% and crossed 200 rupees per kg for the first time in a decade. Now, for an industry where raw materials make up nearly 80% 45% of the cost, this single spike was enough to sort of derail quarterly earnings across the entire board. Now, this rubber problem is particularly acute because India simply does not produce enough of it. We grow about 8 lakh tons annually, mostly in the state of Kerala, but the tire industry actually requires 1.3 million tons. And that gap of 5 lakh tons is supposed to be imported, which leaves Indian tire makers sort of at the mercy of global prices. And when those prices spike, as they did last year for that matter, every single company starts to feel the squeeze. But that said, raw material volatility is just the very beginning. Tire companies also do not control their demand. Only 30% of their sales come from vehicle manufacturers, which is tires fitted on new cars, bikes, and trucks. This business rises and falls with automotive cycles as well. For example, when Hyundai or Maruti cuts productions, tire orders fall as well. And the remaining 70% comes from replacement tires, which sounds more predictable, but it honestly really is not. Now, how long a tire lasts usually depends on everything, right from road quality to driving habits. On a smooth highway, for example, a tire might actually last 40,000 kilometers, but it actually, on the other hand, could wear out in just 25,000 kilometers in a road where there are a lot of potholes. And to make matters worse here, the government taxes tires at 28% GST, which is among the highest rates for any product. And this, of course, pushes many customers to delay replacing worn out tires, which creates both a business problem and also a safety concern on our roads. Now, the industry keeps lobbying for lower taxes, and they argue that affordable tires mean safer roads, but it has not really seen any amount of success yet. And now there is suddenly a very new challenge in this space that nobody really knows how to handle. That is electric vehicles. See, EVs are usually heavier because of their batteries. They deliver instant torque, which puts even more stress on regular tires. They are also quieter, which makes tire noise more noticeable. And all of this sort of requires developing new tire technologies altogether. But with EVs still under 2% of vehicle sales, the question is, how much should companies even invest? Because if you move too early, you'll end up wasting money. But if you move too late, you might end up missing the opportunity. Now, the government has definitely tried to protect domestic manufacturers through trade policy. In June 2020, for instance, India restricted tire imports, effectively shutting out Chinese competitors who had captured 12 to 15% of the replacement tire market with lower prices. Anti-dumping duties on Chinese truck tires provided an additional protection to this. But these measures create their own complexities, and they make the business environment even harder for these companies to navigate. Now, against this backdrop of challenges, India's 90,000 crore rupee tire industry has become a very interesting case study in strategic divergence. See, there are 4 companies, which is MRF, Apollo, JK Tyre, and CEAT, which control about 75% of the entire market. And while they're all making tires, they are all making remarkably different bets about the future. MRF has chosen what you might call the Fortress India strategy. Now, the company generates over 90% revenue domestically, and it operates 9 plants which produce 85 million tires annually. Now, with India's largest dealer network of 5,000 plus outlets, MRF has built deep roots in the replacement market. Last quarter, this approach delivered 7,075 crore rupees in revenue and 512 crore rupees in profit, which is a very healthy 29% jump despite rubber price pressures. Now, what's striking about MRF is its confidence in keeping things simple. See, while competitors chase global markets or cutting-edge technology for that matter, MRF is actually investing 4,500 crore rupees in a new Gujarat plant, which is its first major expansion outside south of India, but is still firmly domestic. The company has also not rushed into EV tires, and they prefer to wait to see which segments actually scale faster. MRF's bet is fairly straightforward, which is that India's market is big enough to sustain focused growth without the complications of global expansion. Anyway, moving on, Apollo Tyres has taken the exact opposite approach. The company generates 63% of its revenue from India, but nearly 30% from Europe, and not just through exports. Apollo actually manufactures in the Netherlands and Hungary, making it a genuinely global company. Now, the idea here is to serve premium European markets with local production while still leveraging Indian cost advantages elsewhere. But that said, the problem is that global ambitions bring global headaches as well. Apollo's recent quarter saw its profits fall to 185 crore rupees from 354 crore rupees a year earlier. Management has been honest about it, and they're calling it a very, very challenging year. They're also restructuring from a regional to a global operating model, and they're facing capacity constraints in Hungary and pulling back from low margin contracts. But that said, it seems like Apollo is still committed to its vision. It was the first company to launch EV-specific tires in India, and with R&D centers in Chennai and the Netherlands, Apollo is betting that Indian companies can compete globally on technology and not just on price. Anyway, moving ahead, let's talk about JK Tyre. Now, this company has carved out a very different niche for itself altogether. The company specializes in commercial vehicles, which is trucks and buses, and it was among the first to produce radial truck tires in India, and they now operate two plants in Mexico that provide a bridge to American markets. Now, this focus on commercial vehicles and export basically means that JK Tyre is particularly sensitive to economic cycles. For example, when freight demand falls, so do truck tire sales. Their last quarter's profit dropped 31% to 102 crore rupees, partly due to expensive rubber inventory that was bought before the prices had spiked. But that said, JK still remains fairly optimistic, and they believe that India's infrastructure growth and export opportunities will definitely drive long-term demand for commercial tires. Anyway, the fourth one that we're discussing today is CEAT Tires, which is the smallest among the four, but it is still making the most interesting bet here. See, instead of competing on scale or geographic reach, CEAT is actually focusing on manufacturing excellence. They recently became the first tire company globally to receive the World Economic Forum's Lighthouse certification for using advanced technologies like machine learning and predictive analysis in production. And despite being smaller than the other three, CEAT actually posted a very strong 14% revenue growth last quarter to 3,421 crore rupees. The company also acquired CAMSO to strengthen off its highway tire business, though benefits will still obviously take time to materialize here. So if you think about it, CEAT's strategy here is very clear. In an industry where bigger has traditionally meant better, superior technology can actually level the playing field in many ways. So now if we zoom out a little bit and understand this, what really makes this divergence very fascinating is that all four companies are essentially trying to answer the exact same question. What will Indian transportation look like in maybe 2030? MRF on one side believes domestic demand will remain massive and profitable. Apollo on the other hand thinks Indian companies need global scale to compete. JK is betting on commercial vehicles and exports, and CEAT believes technology will be the differentiator. Now, the challenge for investors like you and I is that quarterly results really reveal very little about who's making the right long-term bet. A company posting weak numbers today might really be investing in technologies that will not pay off for many years. And another company that shows strong profits might actually be milking existing products while actually falling behind on innovation. But what is definitely very clear here is that the tire business has become far more complicated than just making round rubber products. That brings me to the end of the two stories of the day. On that note, let's move on to the final section and talk about the quick news headlines. First, Apple's key vendors in India, which is Tata Electronics, Foxconn, Pegatron, and Wistron, have surpassed the 20% domestic value addition mark, signaling a shift in the country's role in global electronics manufacturing. According to government records, this threshold was achieved as the companies ramped up local operations, including assembly, testing, and localization of accessories. Second, Jaguar Land Rover has revised its EBIT margin guidance for FY 2026 to 5 to 7%, down from its earlier forecast of 10%. The updated outlook also falls below the 8.5% margin that the company reported in the previous fiscal year. That's all the news and stories I have for you today. I hope you enjoyed this episode. This is your host Anurag Bansal signing off. Take care and goodbye. Disclaimer: this content is for informational purposes only. None of the stocks, brands, or products mentioned are recommendations or endorsements.